Hello, welcome back. If you joined us this morning, and welcome if you've just joined for the Q&A. We'll give everyone a minute to come in. I'm hydrated well. I've got my big cup of water. Did a lot of talking this morning explaining the budget. So this is our second session of the day, answering your questions. We are here to answer your questions, and I am here with my incredible team, Lisa Conway-Hughes and Faye Watts, who are we're going to dig into all your questions that you've sent in, which we're really excited about. Again, this is part of our program with Lloyds Bank Academy. You can scan the QR code and then you get to the website and see all the other stuff we're doing. It's all free to access. You don't have to be a Lloyds customer. There's loads and loads of stuff on there. We do loads of stuff with them too. So please do go and check it out. So, right. Hello, everyone. Welcome and welcome back. We are here to answer questions on the budget. If you missed a session this morning, we did an overview. Well, I say an overview, a deep dive into specific issues that came out in the budget. And I know there was quite a lot of questions coming out of that too. We've had a lot of questions in advance as well, and some of those were sent in before the budget happened, so we'll try and sort of dip in and around. Overall, there's a number of topics that have come up quite a lot. Dividend tax increase, minimum wage increase, pension salary sacrifice questions, business rates, a little bit on tax admin, and allowances. So kind of some of the big topics that we're talking about. Can I ask you, if you do have a question, please pop it in the Q&A box below, because what happens is the chat gets kind of really busy and then we miss stuff. So yeah, if you have any additional questions, please put it in the Q&A below. So if that's okay with my and fantastic team, shall I start digging into the questions and start? Okay, amazing. So let's start talking a little bit about tax questions. We're going to dip into tax questions and come to you, Faye, first. So kind of an overall question around tax rises. In advance of the budget, there was quite a lot of talk about increase to income tax, which we didn't see, which was sort of said we might see it, and then it was announced we won't see it in the run-up to, which I think is a really good example of don't read the headlines, read the actual details. Was there anything tax rise-wise that we should be concerned about in the budget?
I think not necessarily concerned about, no, and I think you're absolutely right. And that's exactly what happened. Is there's so much speculation. We could do this, we could do that. There was also talk about national insurance being handed to landlords. There was all sorts of speculation. There was a 1% potential income tax, 2% income tax. Then there was, a million other things. There is always going to be. And of course, we did have a leak that morning, so we did know a little bit more that morning. But quite frankly, whether we got it in the morning or at 12:30 or beyond is irrelevant. We got that final information on that day. I don't think there's anything that's dramatically damaging, but of course it's going to cost businesses more. They've got to prepare for the extra, increase in tax. But I don't think there's anything that perhaps wasn't particularly expected. I think it was obvious maybe that they wouldn't do national insurance on landlords just because of the implications of national insurance. But as we know, national insurance and tax are kind of the same thing in a way. They're just dressed up and sort of labelled separately. So is it a tax? Is it an NI? I mean, would it ultimately it's costing those people in small businesses with limited companies 2% more, costing landlords 2% more. There's so much more, and we'll dive into that obviously as we talk. But I think they were the real the key. But yeah, I think nothing too alarming.
No, nothing too alarming. I did want to talk a bit about dividend tax, actually, because and I think we'll come to both of you a little bit on this one, partly because it's kind of a personal tax, but obviously it's also a business tax as well. So there was an announcement that the dividend tax would go up by the tax but 2%. So it's an uplift on the basic rate and on the higher rate, which have funny bands like 12,571. I don't know how they pick these numbers. Genuinely don't know how they pick these numbers. And we had lots of questions on particularly sort of solo entrepreneurs who pay themselves predominantly through dividends and not through PAYE. Maybe Lisa, I'll come to you first to get your thoughts on this. And as a if that is your situation, how is this going to affect you, and what should you be thinking about in terms of planning for that?
So I think you need to work out which way is going to be the cheapest for you, and that would be having a chat with your accountant early and getting it prepped. I think as well, the big thing of all of this and which tax bracket you actually end up in is to do with fiscal drag. So I did a bit of number crunching before, and since the personal allowance last went up, inflation's gone up by 25%. So to earn more, you've had to obviously out earn inflation, but also out earn potentially a new tax bracket that you're in. So I think if your salary is increased with inflation, you want to look at which tax bracket you're ending up in. So if over 50,000 roughly, you're in the high rate. If it's over 100, you're in that 60% bracket, and then over 125, you're in the 45% tax bracket. And what can you do about pension planning to try and reduce your tax bracket down if you're just on the cusp? So I think it's all about getting prepared and squirreling away some money on the side to be ready to put into pensions at the end of each tax year.
I know you're always a big fan of pensions, Lisa. This often comes up every time I hear Lisa talk. There's a bit of a like cricket in my head going, why are you not saving more? Why are you like, why have you not given more thought to this? It's always a good discipline. So I guess there's kind of, I guess, three pieces to this, isn't there? So there's what are you paying yourself on PAYE, and are you putting any of that into a pension, and are you and then how are you going to be impacted by the national insurance increase on that, both as individual and a business? And then if you're paying yourself by dividends, how are you going to be impacted by the 2% increase in dividend tax? And it might be that things have changed quite a bit over the last couple of years, and you're better shifting from one to another. And it's interesting what you said about sort of moving yourself, keeping yourself below a higher rate tax bracket. But the only thing I would say with that is that it's quite hard as a business to be able to predict that and to calculate that. So this is why you need a good accountant and bookkeeper to sit you down and do that. Faye, do you have any thoughts on this, particularly on the dividend tax?
Yeah, well, a lot. Well, the one thing that's really interesting about it is, as Lisa highlighted, but didn't sort of perhaps accentuate, is that, well, actually, it might have been you, Michelle, is the additional rate. They haven't added the 2% to the additional rate of tax, which I think is really, really odd. But I'm thinking, my instinct is because of the connection to what's called Section 455 tax. And that's when you're overdrawn and you've got an overdrawn loan account in your company. So I'm not going to go into that detail. But I've been wondering why. Is that coming later? Why haven't they increased that top rate? Because it does mean that anyone who's in a higher earner, who is an additional rate earner, the dividends are going to be not being increased. So it's maybe a bit of disparity there. But and just going back to the fiscal drag point of view, one of the things is this has been 10 years now. We've had these same allowances and these same thresholds. So it seems to be quite a top line headline as well. It's being talked about quite a lot. But what difference does it make if it's been 9 years or 10 years? It's hurting everybody, and it's been hurting everybody every year by not raising those allowances. But I think just to go back to the core of your question, yeah, that 2% dividend rise is going to be fundamental in the decision whether you should be a sole trader or a company. Fundamentally, you are going to be comparing now whether you've got corporation tax rates, which have also risen in the last couple of years, comparing that to a sole trader where the national insurance rate has come down. So, for example, if you're a basic rate taxpayer as a sole trader, you pay 20% basic rate, and then you pay 6% national insurance, and that's 26%. Now, that used to be 29%, and there was a bit more of a kind of, should we say, parity between the two, but that came down to 26%, and that's almost like an incentive to be a sole trader if you're a basic rate taxpayer. Whereas now in a company, you're paying your 19% corporation tax, and then the net difference of that you're taking out as a dividend and paying another 2%. So although I haven't looked at the exact numbers as to where the sweet spot is, looking at it roughly and blindly, if you're earning 50 grand and the business is your profit, you're possibly not better off at all a limited company. You'd be far better as a sole trader. But then you have to factor in limited liability risk of being a company. Now, what is it you actually do? Are you moving goods around, in which case you might need that liability risk within the company? But also things like child benefit. You've got 4 kids and your income is now 60 grand. You're also still under the threshold for child benefit. Several years ago, that was lower. So yeah, fundamentally, it's a big conversation to be having with your tax accountant, because there's no one size fits all. If you're at 100 grand, that 2% is probably not going to make a lot of difference. But certainly if you're under the 50, I think it really is, and you really might be asking that question as to whether to be a sole trader, depending on what you do. Sorry, that was a long answer.
Well, no, it's interesting, isn't it? Because what we've seen a real shift over the last few years from the government. We saw it really acutely in COVID, kind of trying to push people away from setting up as a limited company just to pay themselves. I don't really want to take people back. I want to give them PTSD from COVID 5 years ago. But sort of 5.5 years ago, when we started looking at the measures the government brought in to support people during COVID, if you were on payroll, then you had an option for furlough. If you were self-employed, you had an option for SEISS.
That's
Remember
it.
the acronyms. However, if you were a limited company, you paid yourself by dividends, you were very limited in the support mechanism that was available for you. And the government's there was a lot of pushback actually on this, but the government's response was basically like, essentially, we don't want people to do that. That was essentially it. And it's been increasingly over the last few years, we have seen fiscal adjustments that do seem to imply that the government doesn't want you to just set up as a limited company to pay yourself. If you are a sole trader, then they want you to be a sole trader. If you're a limited company, they want you to act like a limited company. So that, I would say, has been the general vibe and shift. And actually it's interesting talking to businesses, and maybe like 10 years ago, who were advised by their accountants to set up as a limited company and pay themselves dividends because that was the best thing tax wise. It may not be the case anymore. So if you've been going for a while and you've just sort of been doing that by default, it's a good time to relook at that, to have another think about that, and get your accountant to sit down and do those calculations with you.
And just to add, if it worked once, it doesn't mean it works now. People always say, I was always told I should be this. I mean, we just got to park that frame of mind and always think that everything, we get to a new tax year, we should be thinking, what's changed? What should we be doing differently?
Yeah.
And now's the time to be having that conversation.
So sit down with your accountant. Things have changed. It's a good time to have a think about it. I want to jump into questions on not so much paying yourself, but paying your staff and employment costs, and what's happened to employment costs, particularly. So there are a couple of things on employment costs that came out. One was on the minimum wage and the impact of the minimum wage, and one was on apprenticeships, which also came out. Anybody want to? So that in terms of the minimum wage, how is this going to impact businesses? The rise to the minimum wage. Does Faye or Lisa, do you want to jump in? Faye's come out. Well, starting already. Go.
Yeah, I'll jump straight in with that one, because I think that this is one thing that people are saying is the difficulty is the incentive to it's about an 8.5% increase on 18-year-olds. It's a real difficult decision for a business owner to be taking the risk on a young person who may be very young and therefore perhaps very inexperienced, to be paying them £10.85 an hour compared to perhaps the minimum wage for somebody over 21, for example. And it does have a distinct impact on your bottom line. Of course, the more you're paying out in wages, and of course, yes, we should be paying people good wages, and that's not the question. It's the fact that if you are a small business and you are struggling to stay afloat and you're working ridiculously long hours, and you've got this increasing burden of not only national insurance but now the minimum wage, are you going to think about employing as much as you once were. Is it going to scare you a little bit, especially now with the salary sacrifice as well? Although I don't think that should really scare employers if you need the staff. But I think the apprenticeship scheme is really, really interesting, and not enough people are using it because people don't know how. And I would say that that is something that it would be really useful for yourselves actually to do a bit of a workshop on that, and get someone in to do apprenticeships, because I think it's not used well enough, and they are wanting to support some free training for SMEs. So that could be of interest for small businesses.
Absolutely, and it's very much in the plan to do some training on apprenticeships. It came up quite a lot in the chat in the earlier webinar. Just as sort of a recap on that, the government is putting quite a lot of money into supporting apprentices, particularly for people under 25, and for SMEs, bringing in apprentices under 25. They will be fully funded by the government. So this can be a really inexpensive way of bringing new skills and new talent into your business. If you're looking at hiring, I think this is really encouraging. It's interesting. We've had a few mixed things on the minimum wage, and it does hit different sectors differently. Sort of nearly 80% of staff employed by small business are not on minimum wage anyway. So it's fun. We get a lot of questions on this. If your staff are not on minimum wage, then you're not impacted. I mean, at top line, you're not impacted. Sometimes we get the feedback that, but the minimum wage staff go up, then everyone else has to go up. It kind of depends how you're structured. But generally, as a small business, you don't really have the size of staff for that to be having an impact in your business. Most business micro businesses. It's more impacts on retail, hospitality, leisure. This is where we see a lot more of the minimum wage coming in, and the living wage increase has gone up by about just over 4% to 12.71. Obviously it's not overnight. This is from April next year, and we've got a question actually. Why is it not immediate? Why is it always April next year? Lisa, why is it April next year?
Why not? I think, well, presumably they've got to get their own ducks in a row to get us organised, I suppose, and people to plan. I don't know.
It tends to be with the financial year.
I mean, it's simply to do with tax years. It's very difficult to implement tax that's cumulative in a mid-year basis. You have to do it really at the end of the year. Something like capital gains tax, you remember last budget was instant because it's a sort of one-off tax, but anything that affects payroll and adjusting payroll software, internal structures, relaying that to staff would be almost a fiscal impossible, and almost like an impossibility to put in place as immediately. So you'll always find things like that were April. Having said that, caveat, 2 years ago they were always an NI adjustment on the 6th of January, and that was an odd one. But
so yeah, there's a couple of things coming in January. One of the other ones, which I had a couple of questions about, mostly because people tend not to understand what on earth they were talking about, is the 40% first year allowance, which is on allowable capital expenditure. Firstly, somebody tell me, Faye, what's allowable capital expenditure?
So, for example, in your small business, typical business would be a computer, a desk, a chair, your printer, your plant and machinery, whatever plant and machinery you use. That's all your capital allowances. So for your small businesses, you've already got a pretty ample capital allowance threshold called the annual investment allowance. So this first year allowance at 40% sounds like a sweet spot. It sounds like it's really interesting, but most SMEs are probably not going to have that level of capital expenditure. Of course, warehousing, machinery, your forklift trucks, all that sort of stuff. There's going to be a lot. Cafe would have all your cafe equipment. That's all capital. So anything that's got more than a sort of a short lifespan would be a capital. So it's great, but I don't think that's a big incentive for small businesses because they already get the annual allowance investment, which is 100% on their expense. So, but it's there, and it's a carrot to dangle.
Well, they do want to try and encourage people to invest. Well, next year, really. Capital expenditure in your business. So seeing some of those questions coming up for sure. So dipping back into the questions, is the VAT threshold changing? That's a quick one to answer.
No, it's one of the frozen ones. Sorry, I'm jumping in, but
It's all
they're
right.
accounting. No, it hasn't risen, and I think although that feels like a ouch moment, it did rise by 5,000 in the last round. I think realistically, I think actually 90,000 threshold is pretty generous when we compare ourselves to Europe. Some of the thresholds are almost minimal for VAT. Some it's automatic. I don't think it's something we should be complaining about. And I don't think it's surprising that it hasn't gone up. But because people are earning a little bit more, perhaps, depends if they're putting prices up, maybe it means that more people fall into that threshold. So more people will have to register. And those people that it will affect the most are where your business to community, to business to customer, so B2C rather than your B2B models.
Yeah, absolutely. It's interesting. There's been so much speculation over the VAT threshold changing. I think sometimes the speculation is harder than is it going to change? I feel a bit nervous. We hear sometimes about businesses that sort of cap their activity so they don't go into that threshold, and it has gone up a little bit. Just kind of recognizing that over the last. It really hasn't shifted much, but obviously inflation has continued to grow the price of goods and services. At some point, there's going to be a threshold. At some point, there's going to be a jumping off point. The thing that I always say to businesses, are you starting? What are you starting with an intention of? You want to earn a few extra pounds on the side, or is this going to be like a thing? It's going to be your main business, in which case plan from day one that you're going to be VAT registered, because then you're not at a point in your growth process and having to suddenly make a change or rethink your pricing or talk to your customers about, or suddenly cut your margin at a really critical point in your growth process. So if you can start, then you're not then suddenly have to find 20% out of nowhere. So I think that's and there are there's some European countries that do start from zero. Actually, VAT is from zero, so something to bear in mind. I'm keen to come to Lisa with some questions. Particularly about sort of personal tax planning for sole traders, individuals. Making tax digital is coming. And one of the things in the budget is it's still coming. They're not going to stop it coming there, but for some people it will be pushed back to April 2027. Our feeling is get going, get yourself sorted, get your ducks in a row. What would you say on this one? People haven't got themselves organised with digital reporting yet.
Well, it's not something that we talk to clients about. We would leave that to the accountant, really. But I think you've got to be as organised as possible. And I did, I haven't looked at the fine print that much, but it seemed like this was then going to be a way for us maybe to be paying tax a bit more regularly rather than having our payment on account. So I think we'll be forced to anyway, really. I don't know, Faye, you'll be better at this than me.
I think the one thing that's come out of this budget, I think that's brilliant, and it's probably slipped through the net and a lot of things, is that MTD staying, we know that, and that is the burden of the sole trader, because a lot of people are staying a company despite the tax, despite the 2%, because they don't want to do MTD. But then if they're VAT registered, they're doing quarterly returns anyway. But they've given a soft landing, which they said they wouldn't do. And they have now said they're going to give a soft landing, which I think is so important from April 26 for the first year. A soft landing meaning there's no penalties, and they were adamant that you're going to get a penalty if you get it wrong. And my biggest fear is that people try and do it themselves, make mistakes, need help, end up with penalties. But by this way, people have got a year to sort of get it right, and it should be something that people are trying to do themselves and getting their infrastructure in place rather than having to pay their accountants to do it, if they've got the infrastructure. So yeah, plan ahead, get started now, get dabbling. Because if your turnover for 24-25 was over 50k, you're going to have to do it. But the good news, no penalties in that first year. But that doesn't mean get it wrong or budget. It still means get it right. But I think people are still quite in the dark about MTD because it's a bit like, I don't want to do it. So we kind of go, I'm going to ignore it for a little while.
The thing I kind of think is, though, that just as a personal process, obviously, if it's just you're a sole trader and you're trying to manage everything that's going on, there's lots of stuff going on. You've got to do everything. It's just you. And doing your accounting with a bit of software can save you so much time. It can suck in all the data from your bank. It can, you can just email in your receipts for stuff. It's just going to make life easier for you anyway. And then once you're doing that, and once you get used to it as well, it gets quicker and it gets easier. Once you're doing that, you're ready. You're all kind of set up to do it, because the system is going to help you with that anyway. I mean, of course, you're right. So if you're VAT registered, you've been doing this stuff anyway, so it's really not going to hit you. It's really at that smaller end, and everything's always a trade-off at the smaller end. Like, what am I spending my time on? What am I spending my money on? What's going to really help me? But I would always say, and don't buy a kind of great big expensive accounting package that you don't need it. You don't have to spend the money on it. But something simple, kind of entry level, speak to a bookkeeper and get a bit of like advice on that one. It's going to save you so much time, and it's really not very much at all. It's a couple of quid a month often for the software, and then you're ready. You're all kind of set up, and this is the direction of travel anyway, isn't it, Faye? Like this is where it's all going to be.
Totally. And I also think it's going to help you save money, because you do it quarterly, you stay on top of it. You come with a shoebox at the end of the year, go, where's all my receipts, and you've lost them all. You've probably lost so many costs in your business and that you've forgotten about. So quarterly does force you to put money aside for tax. And Lisa, I'll take your point that one day we might be paying it quarterly, because that was the original plan and then they removed that. So let's say that's down the line. The intention right now is just filing, not paying quarterly. But at least you know what you've got to put aside. You've got an idea of how much the tax bill is, because it's so easy to bury your head in the sand, get your tax bill on the 31st of January and try not to open that envelope. I mean, rhetorically, but
do you know what? Actually, that's a really good point, and I'd love to get Lisa's view on this. Is the fear people have of looking at their finances, the fear that obviously not the small businesses, individuals, but small businesses, it's like a terror. There's a brown envelope arrives from HMRC, and I'm just going to hide under the table and pretend it's not there. And it's incredible how much we hear this actually from people. And Lisa, you're always like a really strong voice on empowerment and giving yourself the right information and getting yourself into a good position. Like, if you're a small business, what should you be thinking?
I think, well, knowing your numbers is huge. I actually have a lady who does my numbers for me, so she makes me know my numbers. But I think if you know them, it's like, could you honestly answer the question, how much should I be paying into my pension? How much can I afford to pay myself? If cost of living's going up by 5% next year, or your life's just changing, or you have aspirations to change your life, or let's say your financial plan says you need to be saving an extra 20,000 a year. I know that's a big number, but whatever your personal number is, what do you need to do in your business to make those changes personally? So I think running your own business can be a real gift to your own personal financial planning if you attack it in the right way. Most people do it the wrong way, which is you're so focused on the business, and then you look up and you've forgotten to think about yourself. Whereas if you start the year with, my personal financial plan needs X, Y, and Z, and then you build the business around it with you at the centre, I think you can achieve a lot more.
I think that's good advice, and it's don't be scared of it.
No. And just start small. Like, I can't remember the exact stat, but it's something like 70% of small business owners don't have a pension. But could you afford 50 quid a month, let's say? And if so, just start with that and then increase it to 100 next quarter, 150 the quarter after. It doesn't have to be going full in with the 60,000 a year. I think you just have to start small and get in these habits, because otherwise, I think sometimes as small business owners, we can really miss out on good financial planning.
This is so true, and I think as well, when lots of things are changing all at once, so whether it's salary sacrifice is changing in the budget, and I think we should have a little bit of a chat about that, because also people have asked questions, and I think there's a lot of misunderstanding about that one, or whether it's dividends versus PAYE, or literally how much you pay yourself, and often when we speak to small business, I hear a lot of the time, I don't pay myself because I can't afford to put, like, why are you running a business then, babe? Come on. The amount of times that small businesses will say, well, obviously businesses want to look after their staff. And I'm not saying that's a bad thing, because I think, of course, there's a responsibility to your staff. But when businesses say to us things like, well, I know there's inflation, but I don't want to put my costs up for my customers because I'm worried about my customers. And you're like, if you can't pay your bills, then you're not going to be there for your customers next year. So thinking about how you pay yourself is incredibly important.
Yes. I think you also need to think of yourself as an employee as well, if it helps. Like you might be the employer, but you're also an employee in a way, that you have to think, well, what do you need and what do you deserve for the effort and time you put in? And that just, you deserve the benefits that a regular employee would get, a decent salary for the time and effort spent, sick pay, maybe some life insurance, maybe an income protection policy, and definitely a pension, because you're not going to be able to work till the day that you die, hopefully.
I will be. I'm completely sure. I just noticed that Gail has popped a Making Tax Digital learning module, the link to that. It's all free training, so do have a look at that. So go and pop into there. Then I wanted to come back to you, Lisa, just a little bit on that pension stuff. Could you explain to us what has happened on the salary sacrifice piece in the budget?
So I think people don't understand what it really means. I had someone saying to me on Instagram that she was going to stop her pension payments because she thought all tax relief had stopped, and so there was no longer reason to do pensions, but it's just not true. So say if I am an employed person and I get £100 in my salary, that salary then has to be taxed and national insurance, and then I get some money in my pocket. If I then put that money into my pension, I get the tax back, but I never get the national insurance paid back. So salary sacrifice is a way of taking money out of your salary before you get tax and national insurance and diverting it into your pension. So it's a way of getting that national insurance back that you wouldn't ever be able to as an employee. And the reverse of that is, because you're taking less salary, the employer is paying less employers NI on your salary, which I think, they correct me, is it 15% now? So there's that tax saving for the employer. So what's happening in 2029, so we've got plenty of time, is that you're only going to be able to pay in through salary sacrifice £2,000. Any more than that, and it's got to go in the old way, which means you pay NI, but then you'll get the tax break still. So it's not as drastic or as horrendous as it sounds, but it definitely, I'm interested to see how the pension providers and payroll people make that happen from a logistic point of view. Faye and I were having a geeky WhatsApp chat this morning about does it actually impact directors' pension contributions? And at the moment it doesn't, but we were wondering if their rules might come in the future to change that. But as a director of a company, because you're not using salary sacrifice, you're just directing some of the money into your pension, it goes in straight 100% before any tax or NI has been paid. So for directors, that's not going to change, but for your staff. And then I was thinking from a company's point of view, I think what you have to do is really manage that message well within your staff, because I think people don't understand it. And salary sacrifice just sounds like someone's nicking your income, really, the way it sounds. So I think managing the message with your staff is really important. And then, listening out for if there's going to be any new rules for directors as well along the way.
That's really helpful. Thank you. Faye, did you want to add anything?
I was just going to add to that. And one thing that's really interesting about salary sacrifice that people don't realise is that often when you commit to a salary sacrifice and it's in a contract through as a pension salary sacrifice, or it could be a car salary sacrifice, so that there are other salary sacrifice schemes. but you are sacrificing your income. So let's say you then get a 10% pay rise. You've got to be really clear that when you get a 10% pay rise, is it on the gross pre-salary sacrifice? Because technically it's on the salary sacrifice net income that you may get the pay rise. So you have to be really careful of some contracts that you could actually lose out. So a lot of people don't salary sacrifice for that reason. But the point is, it's not stopping the salary sacrifice. As Lisa said, it's the NI. But the people are going to get that may get hurt as right now, a lot of employers are topping it, or some, where they're getting a saving themselves from the NI, the employer's NI, and they're topping up the employee's contribution as well as a sort of little incentive. We're saving some NI, we're going to top up. How's that messaging going to be relayed? We're going, well, are we taking it back? Because it's now costing us more. So therefore, we're not going to put as much more in. Is that a disgruntled employee? So yeah, I think Lisa hit the nail on the head there with the messaging between employer and staff is going to have to be crucial. But I don't get the £2,000. It's a really random figure over 12 months. Payroll is 12 months.
I read it's because anyone who's anyone on auto enrollment up to a certain amount is not impacted. I think maybe it's basic rate. I don't know. That was the reason for the £2,000. But a lot of employers do more than the automatic enrolment limits of 8% anyway. So I could work it out backwards. Let's see.
There's a lot going on there. One thing actually that we've heard a lot actually from small businesses is that it's the payroll rules are quite complicated, and they seem to change quite a lot when there's a budget coming along, and trying to get your head around them. I mean, I would always say, go to a professional. There's payroll experts, and we use an external payroll organization, the payroll experts who will answer your questions, who will be able to manage this for you, and also do a little do some planning for you, like do some comparison of different scenarios. So definitely I would say, and it's not going to cost you a lot of money to get them to do that, and I think could be really helpful for you and your business to run some of those scenarios, for sure.
Sorry to interrupt you. I just did the maths backwards, and it's if you earn less than 25 grand and doing the 8%, you're not impacted. That's where the threshold lies.
Thank you very much. Question, I think maybe for Faye, this one. With some things around longer term financial strategy, is there anything in the budget that's going to influence future investment or business expansion decisions? We've touched a little bit on the 40% thingy, first year allowance, but is there anything that sort of stands out for you?
There's a couple of big things. There is the EIS and the VCT adjustment. So there's expansion on the investment criteria for EIS and VCTs. However, there's a flip side. So what they're trying to do is encourage more people to use EIS schemes, which is when I use the term scheme, and they are an EIS scheme, is that it's not a scheme, as you know, it's not an off-the-shelf kind of scheme that HMRC don't like. These are approved schemes. But the EIS is a really good way of getting people to come along and invest into your business, and they're expanding the way that's going to work. Because what they want to do is really encourage investment into UK businesses, and EIS gives the tax relief to somebody investing in that business. So I think that's great that they're expanding the rules. They're not changing the relief that you get as an independent, but they are expanding it. However, VCTs, which are your venture capital trusts, they're reducing the amount that you could put in. So instead of getting tax relief at 30%, you're now getting tax relief at 20%. So I think this is going to have a lot of impact on Lisa's clients, where they want to invest on off-the-shelf VCTs rather than businesses. But I think the EIS is a really important one. And the other one, I think, is the encouragement for companies to list in the UK. So if you are, it's kind of bringing business back to the UK to say, if you're going to list and do an IPO and you're going to put it on the UK stock market, there's the share relief effectively on the stamp duty reserve tax. Okay, that might not be on your agenda if you're a small business, but if you've got big ambition, perhaps it is. So these sort of things, I think, are things to get your head around. But there are also some clawbacks about giving shares to staff, like on the EMI schemes and employment ownership trusts. There are some restrictions there. So I think if you're thinking big, I think the EIS is something to really keep your eye on. But as I always warn people, don't get too happy about getting loads of money from other people to invest in your business, because if you don't need that money, you've just given away tons of your equity. So sometimes you can dangle the carrot and people go, brilliant, but then forget actually what they're really doing it for.
I think that's a really good point, actually. And the conversation a little bit over the last couple of years around the lack of awareness and insight into getting equity investment in your business for a lot of businesses. No, I mean, it just didn't occur to them. They've no idea what it would involve. And then other businesses who were like, I don't want to let go of control. I don't want someone to own a part of my business. And we hear this a lot from female founders. I started a business for the control. Why am I giving it? Why would I give it away? But equally, there are opportunities. If you really want to kind of springboard your growth, it might be that kind of an injection of investment externally. If you can't grow organically, the speed that you want to grow, you can't kind of raise that funds organically. That could be a good route to go down, but always get expert advice if you're thinking about doing that. There's, when I've been talking to some of the people that we work with who work in the scale up space, who work with high growth businesses, who were feeling a bit more positive actually about the budget this week, and felt like some of the things that they'd been concerned about, some of the things that kind of might smooth a little bit more growth there. And actually we heard there's been more more VC investment in the last 3 months than there has been in the last 5 per quarter than there have been in the last 5 years. So there's quite encouraging signs at the top end actually. The businesses are getting invested in.
I also think this is bringing Lisa in. I think it slightly goes hand in hand with what they've done to ISAs, is that encouraging more stocks and shares, so people to take a little bit more risk, which is unusual from a current government, but to have less in cash ISA and more in stocks ISA. I know that you've probably got that question lined up somewhere, but I think it's a similar sort of framework about investing into the UK markets.
Yeah, I think we thought the government was going to go that step further and make it compulsory that some of your ISA had to be UK focused, which is not the case. I think that was going to be really hard to administer. But I honestly, so many times, more often than not, when someone comes to do a financial session with me, they usually have too much cash, not enough pension, and hardly any investments, I would say, would be the most common theme. And so we're always encouraging people to reduce cash savings. Ideally, you want 6 to 12 months, no more. But we see people with far too much. So I think if the government's putting that system in place to encourage people to just think about investing or dip their toe in it, even if it is just with 40% of their allowance, and they keep the rest in cash, I think it's helpful.
Thank you. That's really helpful. I'm looking at the time, and I'm just going to ask one more question before we start to wrap up. Actually, there's a question in the Q&A box that I wanted to jump in, which was an interesting one around bonuses. The team don't have a pay rise this year due to financial constraints. Is a one-off bonus a good option to keep people happy, and it reduces our commitment to monthly salaries if things do continue to slow down? Any thoughts on that from both a tax and incentive perspective?
Well, shall I tell you what my business coach told me? He said that an annual bonus can become to be felt sort of almost expected, and so wasn't seen as that exciting moment you would expect it to be. So he's really against bonuses. So I don't know if he's right, but it's something that I'd never thought of it that way, that actually then if you don't give a bonus, it can then become a negative feeling the following year. So yeah, that's my 2 pence worth on that.
Any thoughts, Faye? I mean, any thoughts kind of financially as well as,
Yeah, I mean, a bonus is the same as a salary. So it's still the taxed and NIC in the same way. A large bonus can, it might be due to performance. But I think if you talk this example, I think someone's talking about a little look, thank you very much bonus, and maybe that's a Christmas bonus. Maybe it's not associated with Christmas. Christmas bonuses, I agree, can end up giving the idea that you get a Christmas bonus every year. Maybe it's a God, we've had a tough few months. We want to give everyone a bonus of 500 quid to say thank you. The other thing to consider is the trivial benefits rule. Really useful for giving gifts to your staff as little, not necessarily thank yous for work, but for every so often. It shouldn't be a thank you or a reward per se, but you could give, for example, a bunch of flowers to someone for their birthday. And those sorts of little gifts can sometimes go a long way to just keep people motivated. So if you're interested, just look up the trivial benefits rules and what you can do. As I said, can't be performance related, but can be. I just thought about getting you some flowers. I thought about getting you a bottle of wine, blah, 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 as long as it's under 50 quid. And you could do that 12 times a year. Take them out for pizza, whatever it might be, around on a Friday night. They all fall in with the trivial benefits. And sometimes, those little things can stack up. But yeah, I think a bonus is about how you dress it up, how you make it feel, and how you make the staff feel when you're delivering it.
I also heard someone a bit grumpy complain because their bonus put them in a different tax bracket. So I that might be something to consider. Like, does it change any of the tax brackets for any of the people? And then, well, they don't. The solution for him was just pay anything above that into the pension, and you're back in the old tax bracket. But yeah, I did hear that once.
Back in the day, you used to get your Christmas ham. I mean, or something like that. Your Christmas turkey, or your Christmas ham, or But why not have little things like that where it kind of motivates the team? We like gin and tonics on a Friday, so it's those kind of things that can be really motivating. But then if you are staff in a pool, then also we want more money. But
I love it. I think the Christmas ham is a great place to end today. If you are, so do be careful, and there are trivial benefits which are great. Be careful that you don't kind of go over, because at some point it becomes something that employee need to pay a tax on, if it's a benefit in kind. But I think the decision whether to give them bonuses is a bit of a personal decision. I don't want to be the person that says to you, don't give bonuses to your staff. Everybody hates Michelle now. This is terrible. But it definitely is one to consider, and to consider the tax implications as well. Look, guys, thank you so much for joining us. If you want to recap on all the top stories from the budget, we will be sharing the recording of this morning's session as well. You can share your feedback. The QR code is on the screen right now, and please do check out all the other training, and particularly, Gail did share the Making Tax Digital training program that you can go and check out. We know that's kind of hot on people's mind at the moment. I think my overall thing is always from these sessions: speak to an accountant, speak to your bookkeeper, get some expert advice. I don't think there's anything disastrous to panic about from the budget. There's no kind of huge, great big changes coming down the line. But do go and check out some of the things we've discussed about today. Thank you very much, Lisa. Thank you very much, Faye. Thank you to Lloyd, and we'll catch you all very soon. Thanks a lot. Bye.
Bye.